Something unusual is happening in the silver market today. In New York, silver trades near $70 per ounce. In Shanghai, the same silver is priced around $75. Same metal, same purity, two completely different prices. This is not normal, and it signals a major arbitrage opportunity. For decades, New York dictated silver prices through paper contracts and futures. Today, Shanghai's physical demand is rewriting the rules of the global market. Factories in China are buying silver aggressively for production, not speculation. Solar panels, batteries, and industrial machines consume enormous amounts of metal. The gap between New York and Shanghai has grown dangerously large. Western vaults are being drained, while Eastern demand pushes the price higher. Traders in New York see only a lagging indicator, a paper price. Meanwhile, Shanghai sets the real market value with physical deliveries. This divergence creates a vacuum, pulling silver from the west to the east. Until these two prices converge, the arbitrage gap will continue to widen. Investors watching only New York are missing the full story of supply. The industrial machine in China has accepted a higher price as reality. Each ounce shipped east reduces Western inventory and tightens the market. This is not speculation, it is a physical market event driven by need. The question is simple. Who really controls the price of silver? The answer is now clear. The East, where demand meets reality. This shift is creating one of the most important market dynamics in decades. Every investor needs to understand this before the arbitrage gap closes. Observe the market closely. The vacuum is pulling silver relentlessly eastward. New York shows only $70, a temporary discount to global reality. Shanghai, at 75, reveals the true value of physical silver today. Analysts in the West fail to see the hidden inventory in Chinese warehouses. Massive bonded zones in Shanghai and Shenzhen hold silver away from public view. These warehouses act like a black hole, absorbing global supply silently. Physical demand in China outpaces global mining production, creating a bidding war. Companies compete fiercely, paying premiums to secure the metal for their factories. The gap between New York and Shanghai is not speculation, it is the market's reality. Western banks attempt to suppress prices, but physical demand overpowers their efforts. Every attempt to lower the paper price only widens the arbitrage gap. Silver is being pulled from legacy inventory in London, New York, and Switzerland. The flow of metal eastward is accelerating as Chinese industry hoards strategically. This creates a dangerous vacuum that drains Western vaults week after week. Investors ignoring physical demand risk being blindsided by market fundamentals. The lesson is clear. In a dual market, physical silver always leads the price. Understanding this first chapter is critical before we explore industrial hoard. Now that we understand the price gap, we must look at industrial demand in China. Chinese factories are hoarding silver aggressively for solar panels and batteries. These industries cannot afford downtime. Silver is critical to their production. Each month, solar panel makers consume millions of ounces of silver. This demand alone exceeds global mining production in some months. Factories are buying for the future, not just immediate need. They adopt a just-in-case philosophy rather than just-in-time. This ensures continuous production, even if supply chains are disrupted. Bonded warehouses in Shanghai and Shenzhen store massive silver stockpiles. These reserves are invisible to Western analysts and the public. They act like a black hole, absorbing silver from the global market. Meanwhile, New York and London show only paper inventory, hiding the reality. Arbitrage traders exploit this gap, moving silver from west to east. Every shipment east reduces supply in the west, increasing scarcity. Western banks cannot stop the flow because physical demand dominates. The more they try to suppress paper prices, the wider the gap grows. Investors in the West underestimate how quickly physical metal moves. Industrial consumption in China guarantees a constant, unrelenting bid for silver. The East sets the real price, while the West only reacts. This creates a fundamental imbalance in the global silver market. Physical shortages are no longer theoretical. They are now visible in the East. Prices in New York are a temporary reflection of a lagging market. Shanghai dictates the true value based on tangible supply and demand. Even if New York shows $70, real buyers pay $75. Chinese factories prioritize production over cost, paying premiums without hesitation. The vacuum created by the price gap drains Western vaults week after week. Each week, more metal moves east, leaving less available for U.S. companies. The physical market determines reality, not charts or technical analysis. Arbitrage will continue as long as the East pays more than the West. This gap is creating one of the largest physical market movements in decades. Investors who ignore industrial demand risk being blindsided by market fundamentals. The story is not speculation. It is driven by real-world industrial necessity. Chinese solar and battery production is a major force behind this trend. Even with rising prices, factories continue to buy to secure future supply. They are building a defensive inventory against global shortages and volatility. Western observers fail to see the scale of accumulation in bonded zones. The East is hoarding silver strategically, reshaping the global flow. Understanding this is crucial before we move to the next phase, currency implications. Part 2 concludes with the realization that physical demand in China drives prices higher. With physical demand established, the next focus is currency and global power. The dollar has been the world's reserve currency for decades. This allowed the U.S. to print money and buy real assets abroad. Saudi oil, Chinese goods, everything was purchased with paper dollars. But the world is shifting. China and other BRICS nations are moving away from dollars. Silver is at the center of this monetary transition. When the East pays in local currency, demand for dollars drops. Dollars return home, contributing to inflation in the United States. Silver is the canary in this process, signaling changes in monetary order. The Shanghai price reflects not just industrial need, but also monetary strategy. China is building resource-backed reserves to protect against dollar weakness. Silver, gold, oil, and other strategic metals form the backbone of this system. The BRICS nations view wealth as tangible resources, not digits on a screen. In contrast, the West still values financial claims and paper portfolios. This fundamental difference drives the East to pay premiums for real assets. Physical metal cannot be hacked, sanctioned, or frozen like paper assets. This makes silver a critical hedge against currency debasement. Shanghai now leads the global market by controlling both supply and demand. London and New York paper markets are losing relevance in price setting. Even if New York shows $70, Shanghai dictates the real value. Physical demand backed by sovereign currency makes paper shorts powerless. Arbitrage cannot fully balance the market when East's buying power is dominant. The dual market now shows a fundamental East versus West divide. Banks in the West can no longer manipulate prices easily. Each attempt to suppress the paper market accelerates physical outflow to the East. This creates a vacuum, further draining Western vaults week after week. Investors in the West need to follow East's physical market, not paper prices. The shift represents a structural change in the global economy. The East is using its purchasing power to secure long-term industrial assets. This is not speculation. It is a strategic move with geopolitical implications. Silver is both an industrial necessity and a monetary weapon. Understanding the East's approach is critical for investors navigating this market. The gap between New York and Shanghai is a direct reflection of this shift. Physical silver leads the price, paper markets lag behind. Arbitrage traders profit, but industrial buyers set the floor. This dynamic ensures Shanghai remains the true benchmark for global silver. Investors ignoring this risk losing access to the metal at realistic prices. The West is forced to react while the East drives the agenda. Part 3 ends with the realization that currency, dynamics, and physical demand shape the future. Now that we understand demand and currency, the next step is investment strategy. Traditional advice like dollar cost averaging may fail in a vertical market. Buying small amounts every month can leave investors chasing rising prices. In a market driven by Shanghai's physical demand, front-loading is critical. Position your capital early. Secure ounces before prices move higher. Waiting for a pullback may result in missed opportunity. The Shanghai floor suggests that dips below $70 will be bought immediately. Arbitrage bots react faster than human investors, snapping up any cheap metal. Selling for dollars may not make sense in this environment. Paper currencies are being debased. Physical assets retain real value. The wealthy swap undervalued assets for other undervalued assets rather than fiat. The gold-to-silver ratio provides a powerful roadmap for positioning. Currently, gold trades near 3,000. Silver near 70, ratio roughly 43-1. Historically, this ratio reverts, providing signals to accumulate or swap metals. When ratio remains above 40, silver is cheap relative to gold. Accumulate silver in this zone, ride the volatility, and secure long-term gains. As ratio hits 30, consider trading some silver for gold to protect purchasing power. This is the first checkpoint in a ratio-based investment strategy. When ratio approaches 15, swap most or all silver for gold. This technique allows wealth preservation without touching dollars. It is the method dynasties have used to build intergenerational wealth. Do not follow media hysteria. Rising prices are not necessarily a bubble. Adjusted for inflation, current silver prices are below historical highs. Industrial demand today is far stronger than in 1980, supporting higher valuations. Repricing is occurring as the market recognizes physical scarcity and strategic need. $70 is not the ceiling. It is a launch pad for further gains. Investors must ignore short-term volatility and watch the Shanghai spread closely. The East is buying, the West is reacting, creating a clear directional force. Hold physical silver, secure delivery, and avoid chasing paper profits. Focus on long-term positioning, not temporary dips or chart patterns. Arbitrage and industrial demand will continue to drive the market. The laws of supply and demand guarantee eventual convergence between New York and Shanghai prices. The window to enter the market at favorable prices is now. Patience and strategy are key. Do not let volatility shake your conviction. This concludes the investigation. The Shanghai gap, industrial hoarding, and currency shifts all indicate higher prices. Investors who understand the market, fundamentals can navigate the vertical, move successfully. Ignore speculation, follow physical demand, and act strategically with resources. The opportunity is real, the market structure is clear, and timing is critical. The East is buying silver, the West is reacting,